I am Dr. CMA Aruna Devi from Department of Commerce Professional Accounting. Today let us see AS 20, that is Accounting Standards 20. This relates to earnings per share. So before going into the subject, to study accounting standard, first we have to study the objectives, then applicability and non-applicability of that particular accounting standard, and then conceptual definitions related to the particular accounting standard, and then we have to go to the subject. So let us see the objectives of AS 20. The main objective of AS 20 is to describe principles for determination and presentation of earnings per share. What is determination? Determination means nothing but calculation of earnings per share and presentation of earnings per share in the financial statements of the company, which will improve comparison of performance among different enterprises for the same period. Let us take one example. If there is a particular industry, maybe IT industry, there are two companies, company A and company B. So now we can compare the performance of company A and company B for the financial year 2022-23, or we can compare the performance of company A for the financial year 2022-23 with the performance of A company for the financial year 2021-22. So the both are possible here. So the main objective is to describe the principles for determination of earnings per share and the presentation of earnings per share in the financial statement of the company. Then let's go to the next topic, applicability of AS 20. It is mandatory for all companies, but the disclosure of diluted earnings per share is not mandatory for SMCs. That means small and medium-sized companies. Such companies are, however, encouraged to make those disclosures. Even though it's not mandatory, they are encouraged to show in the disclosure. Then in consolidated financial statements, the consolidated information are required to be presented in the consolidated financial statement. So these are the applicability according to AS 20. Then there are some definitions, but due to time constraint, I cannot explain those definitions. So let us directly go to the determination of earnings per share. The formula for finding out earnings per share, that is earnings per share, are divided into two, basic earnings per share and diluted earnings per share. First let us see the basic earnings per share. So the formula for finding out basic earnings per share is net profit attributable to equity shareholders divided by weighted average number of shares. So let us see the numerator, net profit or loss attributable to equity shareholders. Let me explain with the example, profit and loss account or income statement. Income statement. Now the company balance sheet and financial statements are prepared in the statement form. That is why I am also preparing the profit and loss account in the statement form. See the income statement. First one is gross profit less operating expenses. Operating expenses. So you will get operating profit operating profit. Then this is otherwise called as EBIT. That means earnings before interest and tax. Earnings before interest and tax. So if you deduct operating expenses from gross profit, you will get operating profit. It is otherwise called as earnings before interest and tax. So now you have to deduct interest, because first you have to pay the interest amount to the debenture holders and other creditors. Afterwards, you have to pay tax to the government. Then the earnings available to equity shareholders you will get. So first I am going to deduct interest. So after deducting interest, you will get PBT. That means profit before tax. This is otherwise called as profit before tax, or profit before tax after interest, right? Then next one is less tax. So if you deduct tax, you will get PAT. Profit after tax. It is otherwise called as the earnings available to shareholders. The earnings available to shareholders. Shareholders here means preference shareholders as well as equity shareholders. So we have to deduct preference dividend from this. Less preference dividend. Now you will get the earnings available to equity shareholders. This is the thing we require. Okay, so first from gross profit you have to deduct operating expenses. You will get operating profit. It is otherwise called as profit before interest and tax. And if you deduct interest from profit before interest and tax, you will get profit before tax. Then you have to pay tax to the government. After deducting tax, you will get PAT. This earnings is available for shareholders. Shareholders here means preference as well as equity shareholders. But we want earnings available to equity shareholders. That is why you have to deduct preference dividend also. So now you are getting earnings to equity shareholders, right? Yes. Now let us see the next thing. See, in denominator, weighted average number of equity shares outstanding during the period. So in numerator, we have already found out net profit attributable to equity shareholders, that is earnings available to equity shareholders. In denominator, weighted average number of equity shares outstanding during the period. I have two problems for you. So let's go to the next slide. Weighted average number of equity shares. There is a formula for finding out this. Before that, what are the factors to be considered for finding out weighted average number of equity shares? Here, the number of shares outstanding at the beginning. First factor you need is the number of shares outstanding at the beginning of the period. And second one is buyback of shares, that is adjusted by the number of equity shares bought back. So buyback of shares. If the shares are bought back by its own company, then that number of shares should be deducted, or issued, newly issued shares, that should be added. So these are the adjustment to be done for finding out weighted average number of equity shares. First thing is share outstanding at the beginning of the period, and you have to deduct buyback of shares, and you have to add new issue of shares. So I have two examples for you. Let us see one by one. First illustration, 1st January, that is year beginning. So balance at beginning of the year. So this company is following calendar year. That is why January to December should be taken. So 1st January, balance at beginning of the year, 1800 shares. See, January, February, March, April, May. So up to 5 months, they have only 1800 shares. Then on 31st May, they have issued 600 more shares. Okay, so May, June, July, August, September, sorry, not May. From June you have to calculate, because 31st May, no. So June, July, August, September and October. For the next 5 months, we have 1800 plus 600, that is 2400 shares. Then on 1st November, they have bought back their own shares, that is 300, and they are deleted. That is why we should deduct 300 shares. So 2100 for the remaining 2 months, that is November and December, they have only 2100 shares. Okay. So now I will show you how to find out weighted number of shares. Say, first one, January to May, 5 months, 5 months. So, 1800 shares, okay. So, 1800 into 5 by 12. And for the second period, that is June to October, this is also for 5 months. So 600 shares are bought back. That is why it has become 2400 into 5 by 12. And third step, November to December, that is 2 months. So 300, so 2100 bought back. Bought back and sold or deleted. That is why 2100 shares. That is 2400 minus 300. Here new issue. New issue. So 2 by 12. Okay. See the solution. 1800 into 5 by 12 plus 2400 into 5 by 12 plus 2100 into 2 by 12, that is equal to 2100 shares. So likewise, you have to compute weighted average number of shares. So what is the formula for finding out a basic earnings per share? Earnings available to equity shareholders divided by weighted average number of shares. So earnings available to equity shareholders, we have prepared an income statement to find out earnings available to equity shareholders. And the second one, that is numerator, weighted average number of shares. So we have to consider 3 factors: shares outstanding at the beginning of the period, and if there is any buyback of shares, that should be deducted, and if there is any new issue, that should be added. So we have found out the answer. 2100 shares is the weighted average number of shares. One more example I have. Say, on 1st January, they have 1800 shares outstanding in their balance sheet. On 31st October, issue of shares 600, but actually the face value of the share is rupees 10. Even though the face value is rupees 10, the paid up value is rupees 5. That is why the number of shares issued should be taken as 600 into 5 by 10. That means 300 shares. Understood? So, in the beginning of the year, 1800 shares are available and new issue should be taken as 300 shares. I will show you the answer. See, 1800 plus 300. Okay. So, at the beginning, $1,800. This is for 10 months. Okay. This is for 10 months. That means 1st January to 1st January to 31st October. So, for 10 months. And new issue of shares. New issue of shares. This is on 31st October. So, for 2 months, 1st November to 31st December. So, for 2 months. So, 1800 for 10 months and 1800 plus 300. How to find out? 600 into 5 by 10 is equal to 300. So, you have to add with this 2100. Understood? So, for 10 months only 1800 shares and for remaining 2 months 2100 shares. So, you can use this format also. There are 2 methods for finding out the weighted number of shares. Okay. Then next one. Now let's go to the problem. Now we are going to find out basic earnings per share. Okay. Net profit for the year 2016 18 lakhs rupees. Net profit for the year 2017 16 lakhs rupees. Number of equity shares outstanding until 30th September 2017 20 lakhs. So, number of equity shares outstanding until 30th September 2017 20 lakhs. Then bonus issue which was on 1st October 2017 was 2 equity shares for each equity share. So, if you have 1 equity shares, you will get 2 equity shares as bonus shares outstanding at 30th September 2017. Okay. So, இப்போ நீங்க நினைக்கலாம் என்னன்னா 30th September வரைக்கும் 20 lakhs shares அதுக்கப்புறம் 1st Octoberல இருந்து தான் 20 lakhs into 240 lakhs shares add ஆகி 60 lakhs shares மாறும். But it is wrong. For bonus issue, even though the bonus shares are issued on 1st October 2017, it is deemed to be issued on 1st January 2017. So, you have to note it down. For bonus issue, even though the shares bonus issue was made on 1st October 2017, it is deemed to be issued on 1st January 2017. That is why there is no need to find out weighted average number of shares. But you can take it as it is. That is number of equity shares from the beginning 20 lakhs plus bonus shares 20 lakhs into 2, that is 40 lakhs. That is why total number of shares 60 lakhs. Okay. So, let us go to the solution. See, number of bonus issue 20 lakh shares into 2. That means what? For each share, they are giving 2 bonus shares. So, already they have 20 lakhs number of shares. So, now they are going to issue 40 lakhs bonus shares. So, already we have 20 lakh shares. Now, we have 40 lakhs bonus shares. So, total number of shares 60 lakhs. And see, earnings available to equity shareholder means here there is no variation. That is why we can take the net profit as it is as earnings available to equity shareholders. So, net profit for the year 2017 60 lakhs. So, in numerator earnings available to equity shareholders 60 lakhs rupees divided by weighted average number of equity shares. Here there is no need to find out weighted average number of equity shares because in case of bonus issue it is deemed to have been issued from the beginning of the year. That is why total number of shares are taken. So, already we have 20 lakhs shares. Now, we have issued 40 lakhs shares. So, total 60 lakhs shares. See, 20 lakhs into 2, 40 lakhs shares and already we have 20 lakhs. So, in denominator 20 lakhs plus 40 lakhs 60 lakhs shares. Earnings per share, net profit for the year 2017, 60 lakhs. So 60 lakhs divided by 60 lakhs, rupee 1 per share. This is the answer, rupee 1 per share. Okay. So this is the way we have to find out basic earnings per share. Now let us go to diluted earnings per share. What is diluted earnings per share? Diluted. So we have heard this term diluted. So for example, if there are 20 lakhs number of shares and the profit available for equity shareholder is 60 lakhs. So what is the formula for basic earnings per share? Earnings available to equity shareholders divided by average number of shares. So 60 lakhs divided by 20 lakhs, rupees 3 per share. Rupees 3 per share they have. They are enjoying rupees 3 per share. But sometimes convertible debentures are issued. Have you heard about the word convertible debentures? Yes. After a particular year, instead of redeeming the particular debentures, they are converted into equity shares. See, once again I repeat, instead of redeeming the particular type of debentures, that is convertible debentures, the debentures are converted into equity shares. Now, already they have 3 rupees per share as earnings per share. But now the debentures are converted into equity shares. Okay. So the number of equity shares will automatically increase. So it will dilute the earnings per share. Right. So here we are going to find out diluted earnings per share with one best example. See, net profit for the current year 1 crore. Number of equity shares outstanding 50 lakhs. Basic earnings per share, yeah, we know 1 crore divided by 50 lakhs, that is rupees 2 per share. But now there are some convertible debentures in the company, and this year they are going to convert the debentures into equity shares. So from the next year onwards, the earnings per share will be diluted. So number of 12% convertible shares of rupees 100 each, 1 lakh. So they have 1 lakh number of debentures. So what is the procedure for converting the debenture into the equity share? See, in the problem it is given each debenture is convertible into 10 equity shares. So one debenture worth of rupees 100 each is converted into 10 equity shares of rupees 10 each. Okay, so it is tallied, no, 100 rupees worth of debenture is converted into 10 rupees worth of equity shares. That is why 1 lakh debentures are converted into 10 lakhs equity shares. So already we are having 50 lakhs number of equity shares outstanding at the beginning of the period. So already we have 50 lakhs shares. Now we have 10 lakhs equity shares. So total number of equity shares outstanding is 60 lakhs. Okay, fine. Now there is one more alteration we have to do, because if the debentures are converted into equity shares, there is no need to pay interest to the debenture holders, because they have become the shareholders and they are eligible for dividend. They are not eligible for interest. That is why that interest amount should be added back. That interest amount should be added back. Okay, how much is the interest amount? Yeah, they have given as 12 lakhs. Okay, so that interest amount we won't get further, because the debenture holders are converted into this one. Which one? The equity shareholders, right? But at the same time, we have enjoyed tax benefits so far, because for interest we are not paying any tax. After deducting interest, we will pay tax to the government. That is why we don't calculate tax for interest amount. But now interest is not paid. If interest is not paid, we should pay tax amount to the particular thing. that is for 12 lakhs interest amount. So they have calculated 12 lakhs at the rate of 30%, that is 3 lakh 60,000. So it is clear that we have to reconsider the net profit after adjusting these two items, that is interest expense and tax on interest. See the solution. Yes, adjusted net profit. So the net profit is adjusted accordingly by considering the interest expense and the tax on interest, right? So 1 crore plus 12 lakhs interest expense minus 3 lakh 60,000 tax on interest, right? So you will get adjusted net profit of rupees 1 crore 8 lakhs 40,000, right? Then number of equity shares already we have calculated. So in the outstanding at the beginning 50 lakhs equity shares are there already, and now 1 lakh debentures are converted into 10 lakhs equity shares. So 50 lakhs plus 10 lakhs, 60 lakhs number of shares. So adjusted net profit divided by number of shares. So 1 crore 8 lakh 40,000 divided by 60 lakhs is equal to rupees 1.81 per share. So this is the way you have to calculate diluted earnings per share. So there is no much difference between basic earnings per share and diluted earnings per share. In diluted earnings per share, the shareholders get diluted earnings per share as their dividend. Okay. So dividend is entirely different from earnings, because all the earnings are not distributed as dividends. Only a part of the earnings are given as dividend. So remaining part is taken as reserve or provision. Sometimes it is treated as retained earnings. So all the earnings are not distributed to the shareholders as dividend. Okay. So already they have little amount to distribute. So in this, if the debentures are converted into equity shares, it is again diluted. Okay. Thank you. Thank you so much.